Good afternoon, everyone. Hello and welcome. We thank you for joining us today, and welcome to MBA's State of the Mortgage Industry, Building a Sustainable Operating Model for 2021 and Beyond. Before we go over the general layout and functionalities of the Adobe space, I want to ensure that everyone can hear me. If you can hear me, please raise your hand. You can raise your hand by using the little icon at the top of the screen. That looks like a little person raising his hand. All right, great. Looks like the majority of you are hearing us very well. Wonderful. We appreciate your cooperation. You can click that same icon to lower your hand. Okay? All right, thank you very much. Alrighty. We have a very large participation today. So we will try to see if we can't get everyone in. Alrighty. Now, briefly reviewing the Adobe space. First, there's a chat function that is located below the presentation. This is where you will direct any of your questions at any time throughout the presentation. This is your way to interact with the speakers. At the end of the presentation, we will have a short survey. Please provide your honest feedback. This will actually help us to improve on future courses and webinars. All right? Now, to get us started, I'd like to introduce our moderator for today, Mr. Rohit Kapoor. Rohit is the co-founder and CEO of EXL Service, Inc. Prior to founding EXL, he served in various senior executive roles at Bank America and Deutsche Bank, both in America and Asia. Rohit, thank you so much for joining us today. We really appreciate your being here. Tell us a little about yourself, and please introduce us to our distinguished panel.
Thank you, Rosalind, and good morning, everyone. It's great to be here, and I think we've got a very interesting topic with some really experienced and distinguished speakers and panelists. So I'm really looking forward to this conversation. First, let me introduce the panel to you. Stan Middleman is the founder and CEO of Freedom Mortgage. Freedom Mortgage has been in business for the past 30 years, and Stan is an experienced professional in this industry, and he also serves on the advisory boards of Freddie Mac and Fannie Mae. Next, we've got Sanjeev Das, who is the CEO of Caliber Home Loans. Sanjeev has also got deep industry experience in the mortgage space and previously worked at First Data and also ran all of Citi Mortgage in his past years. And then we've got Paul Anasos, who's the Chief Innovation Officer at Guaranteed Rate. And Paul has been at the forefront of innovation within the housing industry for a decade, developing technology solutions and transforming businesses into industry powerhouse. A little bit about myself. I'm the founder and CEO of EXL Service. EXL is a data analytics and operations management company, and we try and help our clients to help them leverage data and create value for themselves. We do that in two fundamental ways. Number one is we help our clients make better business decisions using data, and that is what we call as data analytics. And the second piece is we help our clients use the data that they have about their end customers and combine that data with external sources, convert unstructured data into structured data, and apply intelligence and insights from that data into their core operating processes so that they can improve customer experience, they can serve their customers at a much lower cost, provide flexibility, and provide resilience, all in a very economic environment. So that's who we are. The topic for today is actually a very hugely important topic, right? Just talking about the mortgage lending industry, which actually impacts every one of us. So it's something which is very close to our hearts. But at the same time, it's a fascinating space given all the things that happened in 2020. And we're going to talk about some of the changes and some of the impact that took place in 2020 and what the future for this industry is and how can you leverage digital transformation, how can you leverage data, how can you leverage analytics, how can you leverage talent in this new world that we are entering in and kind of continuing to operate in. So first off, 2020 was a unique year for the mortgage industry. It was a year which had a dual complexity to it. On the one hand, with the low interest rate environment, the mortgage lending was at an all-time high, and we had almost $4 trillion of mortgage lending. And within that, the refinancing was a big, strong component at almost $2.4 trillion. New home sales exploded and were 200% up, and that's at a 16-year high. So there's a huge amount of volume of activity that was taking place on the one side. On the other hand, there was a high unemployment rate. There was a huge impact to a large cross-section of society. There has been a very uneven recovery that is taking place, and therefore there is a very strong displacement that has taken place on the other side. And in the middle is the mortgage lending industry, which itself got displaced, right? Because all the workers, instead of working from the office, had to work from a distributed work environment, and the industry itself had to change to serve a much higher growth demand environment, and on the other hand, a very uneven impact and dislocation that has taken place. So it's a fascinating time to be here, and really the use of technology, analytics, data, digital transformation, and talent becomes extremely important. So we're going to talk about this with our three panelists, and I'd like to break it up into three parts. The first part is really to talk about what happened in 2020, how did each organization really deal with the change that took place in 2020, and how are they effectively using different strategies and levers to be able to manage this dual complexity that was thrust upon the industry. The second piece, we're going to go deeper into the use of digital transformation, the use of data, the use of analytics, and the use of talent. And in the third section, we're going to talk a little bit about the future as to how do you create a sustainable operating model that can withstand this kind of volatility and this kind of surge in demand and this kind of change that is taking place. All right? So with that, let's get started. Let me pose the first question to the panel, and I'm going to ask each panelist to address this first part. So let me start with you, Sanjeev. 2020 was a period of enormous change for everybody, not only the mortgage lending industry, but for everybody, and certainly for the mortgage lending industry. So for you, what were the big elements of that change, and how did you deal with that in 2020?
Thank you, Rohit. And first, let me thank you and EXL for hosting a great panel. You guys are one of the most innovative folks out there, and I really appreciate your taking the charge. It kind of sets the tone for the discussion today in terms of data and digital and how the world is moving forward. I also want to thank and acknowledge my friend, my colleague, and a legend in the industry, Stan Middleman. Stan's learned a lot from Stan over the years. And of course, Paul, you are the new face of the industry, and the next generation that will, through innovation, get us there. So Stan will always lead with innovation, and you are the next generation. So delighted to be here, Rohit. So thank you all for doing this. Let me answer your question first. Obviously, 2020 was an extraordinary year. As Rohit mentioned right up at the beginning, two major things happened. One was there was extremely low interest rates, historically low interest rates, which caused a huge wave of refinancing, which obviously, from a long-term consumer credit standpoint, puts consumers in a really good position in terms of the largest debt that most consumers have. with outlays that are supposed to be a very large part of most people's average wage. And so delighted that, this has come down for consumers in a way that I think will make the industry robust in terms of consumer creditworthiness for a very long period of time. The sad part of this, however, has also been that because this was linked to a pandemic, which caused a huge amount of economic disruption, particularly in the services sector, large numbers of consumers lost their jobs or were furloughed and had huge disruption in their income, which would cause, through forbearances and the CARES Act. I think we managed to pretty much plug some of the short-term impact, but the long-term impact remains to be seen. And I think that different versions of the CARES Act will continue to plug it, but until such time as the economy really becomes robust, it's hard to see that there won't be some implications of this. And so they're all gearing up for making sure that we continue to protect our consumers and the homes that our consumers live in. So those are sort of, from a consumer standpoint, really important. And then I'll touch on a couple of other quick things real quick, so I'll give the other panelists a chance to speak. But at the same time that we saw this huge refi wave because of people just refinancing, we also saw a forbearance wave, which has now come down pretty substantially. We've now started to see a third dimension, which is a purchase wave, as consumers start to move from this urban to suburban shift, which really got accelerated, in my opinion, for a couple of reasons. One, people just wanted to move to the less intense cities from urban to suburban. Second, clearly the tax implications of intense cities were starting to impact towns and cities and states that were lower tax. But I think that this process of moving from urban to suburban, which are extremely well networked and the infrastructure is extremely good, demonstrated that consumers feel quite comfortable in this trend, and that this trend might actually continue for the next 2 to 4 years, in my opinion, and is not just a short-term phenomenon. And so to that extent, the intersection of low interest rates along with consumer migration in purchase has been extremely good for the industry, and I think will continue for some time to come. The refi wave may slow down towards the end of the year, but I think the purchase trend will continue to be very strong. With that, we can pass it back to the panelists.
That's great, Sanjeev. Thanks for that. And, I think it provides a great perspective on the big macro element shifts that are taking place. And we'll go a bit deeper into this move between urban to suburban, as well as, individual consumers trying to optimize for the tax rate. But Stan, if I could ask you the same question, but also add to it the dimension that how did you at Freedom Mortgage balance out the priorities? On the one hand, an increased demand. On the other hand, the forbearance and the CARES Act, which needed urgent attention. And on the third side, your own internal, reorganization and kind of, rearranging how you as a business operate. If you can provide some color around how you manage these three competing priorities at the same time, in and where everything was changing, that would be very helpful.
It'll be my pleasure. Well, first of all, thank you for having me here today. And it's nice to see Sanjeev and Paul. I'm delighted to be here. I think the crux of what happened was outlined very nicely by Sanjeev. And then the next question, as you just so thoroughly put it, is what are we going to do about it? The reality was stark. If you go back to those days of disruption when our world closed down and the wild swings in the marketplace, the wild variations in liquidity and in lifestyle and in fear, we've almost become diluted in our feelings, right? We're so muted in the way we feel about this. We've gotten used to it. that it was so acute at that point in time when it happened that we had an awful lot of things that had to take place to allow us to be resilient and to deal with our realities. And I think the fact that cooler heads prevailed and we were able to attack all these issues in a compartmentalized fashion is really what allowed our industry as a whole to respond. Obviously, some people responded better than others, but I think that the key to the whole approach was this. First of all, compassion, understanding, empathy, and in regards to all things, thinking of the consumer and the employee first, because they're almost one and the same, right? So your employees are consumers. Many of your consumers are employees of at least somebody. So the reality is that there was an awful lot of personal fear and tragedy. So your first and foremost responsibility, at least I felt mine was to give order and confidence to those around me, whether it was my customer, whether it was the employees or my peers, was I tried to create an environment of stability. We woke up one morning on a Thursday and everything was normal. We woke up Tuesday morning of the following week and 98% of our work staff was working remotely. We had the good fortune to have practiced a lot of disaster recovery, and we had dealt with the realities of disaster recovery and things like snowstorms and hurricanes and floods. And we just deployed all of these exercises on a massive scale. Now, had we ever tested those capabilities on that scale? No. But the reality is it only took us 4 or 5 days to really get the entire organization functioning. And it probably took us another week to make the organization effective. So the first job was functionality, the second job was effectiveness. As we played into this, I think we faced a couple of challenges. The first challenge that we faced was the real fear that there wouldn't be any liquidity. And the government machine gunning all of these potential outcomes at us, one after the next, including the concept of forbearance. And we knew that something had to be done, and that the act took place before the infrastructure to support the act existed. So there was a shockwave of fear that reverberated throughout the industry. One of the respondents to that fear was Sanjeev, and another myself, and many of our peers across the entire sector. And the real crushing blow was the liquidity. The dramatic changes in the marketplace drove many of our peers to the brink of bankruptcy. The reality was there weren't that many companies that were terrifically well positioned coming into this period in time from a cash standpoint. We were coming off of 2 very difficult years. Volume had been incredibly low. Cash balances in the industry as a whole were fairly low. We were fortunate enough and positioned well enough that it wasn't as significant to us, but if there wasn't a solution, it would become significant not only to us, but to everybody. And we were really at the precipice of a potential disaster. And many people were looking for help from the government. And there was a lot of ill-conceived notions about how that help had to come. People were in line for advances and credit lines, and that really wasn't what we needed. What we needed was what actually happened, and that was for the government to come in and do an infusion of capital into the system by buying the MBS. And the Fed stepping up to buy MBS really was the solution. Unfortunately, kind of like the vaccine, A lot of people got a cold that was pretty significant as soon as that infusion showed up, and we saw a whole bunch of companies really push to the edge through margin calls and a liquidity crisis. So when we think about what happened, you had the physical preparation of moving everybody from in-office to out of office, and so almost simultaneously, or bang, bang, immediately thereafter, we had, in effect, a liquidity crisis that was threatening the ongoing businesses where most of this volume really had moved. You know, a lot of the activity had moved from banks to non-banks, so the non-banks were really exposed, and there was fear, you know, going through the system, and a lot of finger pointing, quite frankly, and most of it was mostly unnecessary. So these companies responded. Interest rates fell. I think pretty well everybody stabilized and then began to thrive and start to put record on record on record on record. I know that everyone that I've spoken to has done huge volumes, but there was more than that. There was a social responsibility that emerged. Those people that work in the industry that had servicing books had to essentially make the payments for their consumers. And these payments included principal, interest, taxes, and insurance. And we really ended up, because of the government help that was given, which was virtually none applied, the individual firms had to advance this money. And the fears around whether non-banks would be able to manage this was palpable. But in fact, not only did they manage it, but they thrived in that environment. And none of those liquidity risks really held out to be true. Now, I have to tell you, it was scary, but we're seeing continued movement to the non-bank sector of the distribution of this activity in mortgage. And it appears that will continue. And without people like Sanjeev and his peers rising up and doing the outstanding job that they have, caring for the consumers, making their payments, managing folks in forbearance, helping make their payments for them, and letting them continue their lives so they can focus on their health and happiness, I don't think that we would have gotten to where we have. And in addition to that, we've seen a charitable portion in our industry where people have stepped in and made huge donations. We put a lot of money and effort into Feeding America, and I've seen different companies rise up and do different things from a charitable contribution that just restores your faith in mankind. The consumer, the employee, the neighbor, the community, the friend, all the things that make our jobs gratifying have all shown themselves to be more than up to the task. And I'm really proud to participate in our industry and to live in the communities that made all this much better than it otherwise could have been.
Thanks for sharing that, Sam. And, you know, I think we all applaud all of you for doing your part out here, because this human ingenuity as well as bearing that social responsibility is so critical to make sure that the industry is healthy and everybody within the industry can kind of continue to operate as normal. Because we all know that if the mortgage lending industry catches a cold, it'll impact everybody. And we don't want that to happen. So thank you so much for that. Paul, let me kind of wrap up with you as to how did you think about this, particularly from a lens of innovation, the use of technology, because the volatility in volume, the changes in regulation, the speed at which things were shifting and tectonic plates were kind of moving around, that was massive, right? And how did you deal with it? And if you can throw some color on the use of technology, that would be great.
Yeah, you bet. And thanks, Rohit, for having me here. And, you know, Sanjeev and Stan, thanks so much for being on the panel together. And thanks for the great attendance. It's nice to see so many faces here for sure, or at least names. Yeah, from a technology perspective, you can almost look at it from two phases in my mind. First, as Stan mentioned, mobilizing all of our staff. It's not uncommon for us to have, call it 20 to 30% of our staff working remotely. And pretty much overnight, that changed to pretty close to 100% of it, or 95% of it. So making sure our systems, making sure people working from home had adequate networks and technology that they could move really fast, making it so we could speak to each other or one another on a nightly basis. I think video conferencing, has certainly risen. We used it as a company. Now we live on it, and probably are on it more than we'd like to be. And then I think we were tested over the years. We've always had challenges with how do we hire enough staff in a rally? What happens when the market compresses, when we've hired so many talented people, how do we ride that out where we can sustain that? How do we continue to grow the entity? How can we scale the entity in any environment? And we've seen in other rallies that we've had to mobilize around that. This was unique, into how big the rally is and how it's still going on. And as Sanjeev mentioned, may be going on for a number of years. Some of what's helped is some of the regulatory requirements that just had never loosened up in our industry around, how you'd have to do an appraisal, doing remote closings, things like that. A lot of states, even some still, don't allow for a remote closing. So the states loosening up the guidelines around that was important. It really lent itself to all of us being more creative in how we applied technology. We took advantage of a lot of machine learning, a lot of artificial intelligence. I think those things were further into the future than they are now, and now those things are right in front of us, and I'm sure a lot of people that are here today are using those capabilities. So for us, it was really a dramatic step forward in taking advantage of tools that were readily available in other businesses and actually applying into the mortgage industry and really taking this business forward as a whole.
That's great. That's great. So it's great to see the response, of the mortgage lending industry act with agility and speed, act with compassion and responsibility, use innovation and creativity in terms of addressing these mega challenges and opportunities that got created. So let's go into the next part of our conversation, which is really about leveraging data, leveraging digital transformation, leveraging technology and automation to improve end customer experience, to reduce cycle time, and to increase the speed at which things can be done, and to be able to create a greater amount of resiliency and flexibility in the delivery of services here. So I know that there are a number of functions, for example, the underwriting function that suddenly saw an upsurge of demand, and there was a huge need to be able to recruit underwriters to manage that. And there was a big role that technology played in terms of making sure that there can be greater automation and greater efficiency so that you could do more with less people. And that was, one aspect that I know we were helping our clients work through in the industry. There was also this element about better use of data and knowing more about your customer and helping them out in that journey of getting a loan and actually improving their customer experience. And then, the last piece was, how do you apply analytics to kind of position yourself to be in the right place at the right time with the right product and deliver that. So let's talk a little bit about that and also about how do you see this going forward into the future. So Sanjeev, let me ask you this, that, most organizations today would say that use of data and becoming a data-led organization has become a critical factor to long-term success. How do you think about applying and using and leveraging data so that you can serve your customers much better, much faster, much cheaper?
Thank you, Rohit. I think if anything, 2020 and the surge of volume that we all experienced as lenders demonstrated perhaps more so than anything else the need for efficiency in what I call manufacturing. Rohit, as you know, I've worked across all parts of the consumer finance and lending businesses. There is no business that has more data than a mortgage business. I mean, it's just inundated with data. And yet, when you compare it to, let's say, the payments industry or the credit card industry specifically, the use of data as the proportion of data that's available is probably the lowest. And I say this from the inside because I own the responsibility for that, and I know that Sam agrees with that. Having said that, we are probably one of the two biggest users of data between Freedom and Caliber in terms of how we deal with consumers and how we actually use data to predict which consumers are likely to be in the money so they can refinance and we can reach out to them and tell them what their options are. But as an industry, I think the reason why we are stymied on the use of more consumer data, including income data, employment data, to make the manufacturing more efficient is because that data is not very well organized. And so it's great to have firms like EXL that, as you said, can take unstructured data and make it structured. And I think that the joining of hands with us as an industry, with folks like yourselves who think about data in a very forward-looking way is really important, because there is no point us being able to not use the data. And so we have this very simple vision. I actually think that the business of mortgages can be the most complex, but it can also be described somewhat simply, because unlike in the rest of the world, essentially and I'm oversimplifying it when I say this, in the U.S., Fannie and Freddie has somewhat simplified the mortgage business and made it essentially a commodity, which is defined by a set of rules. Now, again, I know I'm oversimplifying it, but it's very different to the bespoke balance sheet businesses in the rest of the world. So when you have a set of rules set by Fannie and Freddie, for the most part, you should be able to take a simple W-2 conventional loan, and with the use of data, should pretty much be able to make your manufacturing such that it's essentially only done by machines and needs to be done by humans only by exception, so that you avoid things like redlining and whatever else. You don't want the data to quote-unquote discriminate, if I may say so. But the ability to manufacture, and as I said, the mortgage business in some ways is actually quite, because it's a commodity business, if you don't get your manufacturing right, you essentially are not able to get the real benefit of scale. And once it's a 5 to 8 to $3 trillion industry at any point in time, highly fragmented. And so manufacturing quality or manufacturing efficiency through the use of data, automated decisions is really important, so that you can take those savings and pass it back to the consumer. And so I feel very strongly about how that data is organized, and we are doing a ton of work on it. But I actually believe that Fannie and Freddie and the agencies can help a lot in helping in the organization of that data. And I think that that's where the industry is going. The second piece is, again, the use of data and things like blockchain technology. I think that the use of blockchain in order to help in the servicing process, and now that on the other end we have a common securitization system, but if we had blockchain that essentially enabled us to service loans in a way that it doesn't go through the inefficiencies of human touches, that also would be a good thing for a business which is essentially a commodity-driven business. Now, I put it all together, and I gave you a very manufacturing view of the world in terms of how manufacturing efficiency through the use of data and automation can, in fact, improve manufacturing efficiency. But from a consumer standpoint, here's how I think about it, Rohit, and I know, again, Sam feels the same way. We've talked a lot about this, is you take those savings and you pass it back to the consumer. And look, today we use it, as I said, mostly for prediction models, but we could use it much more for manufacturing. And once again, I'll pause there because I know folks on the panel probably know a lot more about this than I do.
No, that's great, Sanjeev. We at EXL believe that, using data, you really need to kind of think about it in three levels. One is having access to the data, so converting unstructured data into structured data and making it usable. The second is really about illuminating and shining the light on data. Many organizations have data residing in, but they don't have it accessible, they don't have it visible, and they don't have the transparency in terms of the use of that data. So that's the second level. And then the third is, I think, something which you're also talking about, which is using the data and combining it with external data or combining it with data that Fannie and Freddie can provide to you and actually allow you to take much better decisions. So that combination and creating a better maturity of being able to use that is a critical component of adding value. So let me kind of switch to Stan. And Stan, I know that you've been adopting a fair amount of digital transformation in your operations and in your business to try and create more automation, more efficiency, and actually reduce the time that it takes from the time you get an application to the time that a loan is disbursed and bring that period down. How is Freedom Mortgage thinking about a continuous process of embracing technology and change in automation in terms of driving this forward? And if you can give some sense of what your vision of the future end state might look like, that would be great.
Sure. This does end today, right? So I can't spend all day with you describing that, which I probably could. But I think that in terms of embracing technology and data use and mining the information that's available to you is something that's not optional. So when I think back to the beginning of my career, where we thought a technological advancement was whiteout, and there's probably half the people on the call don't know what whiteout is, or having a line of memory in your typewriter and using carbon paper to create disclosures. Where we were and where we've come all really evolved and revolved around data and information and technology. And being able to make the customer journey smoother, really it comes down to a word that Sanjeev used over and over and over and over in his discussion: manufacturing. The manufacturing process. The identifying, gathering of information about the consumer that becomes your customer and doing it at a very low cost relative to your peers. So we are people that stand on the shoulders of giants. All those things that came before us led us to where we are now, and where we are now will lead us to where we go next, because the needs at any point in time become very obvious. And then you use the tools at your disposal at that point in time to become a lower cost producer of your product. And that's exactly what's happened in our industry. That's what happens at Freedom Mortgage. I'm sure that's what happened at Guaranteed Rate. I'm sure it's what happened at Caliber. I'm sure it's what happened at Quicken. We all looked at where are we today, what are the tools at our disposal, and what can we do to make the manufacturing process less costly. And in return, if you're the low-cost provider, you can be a high-volume originator and servicer, because you're able to gather customers in a more cost-effective fashion. And people move in their enlightened self-interest. So if you want to get the most customers, be the lowest cost provider. It's a pretty simple equation to build success. And that's really the way we see it. We kind of go by faster, cheaper, better, compliant. And if you don't follow all four of those, you're going to be left behind. Because even if you're able to make money, if you aren't compliant, you're going to end up giving it back anyway. So the reality is that you have to use everything that's come before you to take you to where you want to go next, because that will crystallize the vision of what you have to do next. And the way you do all the things that you do next are using the tools that are at your disposal. If there is an artificial intelligence, you can't use it. Today, we're going to use artificial intelligence. We're going to use machine learning. But tomorrow, we may just think it will happen. So we have to be in a position where we've taken advantage of all the things that are at our disposal today and have our eyes wide open so that we can seize the opportunities that tomorrow brings. And one of the problems that happen to the folks that come before us and why the species or companies become extinct is they become too married to the tools at hand. And that's the key. The key is to understand that there is no end. There's no place that we go that is the end place. It's all just a journey. And you have to use all the tools at your disposal to be employed during that journey. And that journey is to be the low-cost producer at that point in time so you can best service your client. And that's the challenge that each of us face each and every day.
Dan, I can so relate to what you're saying, because at EXL, the way we've defined our purpose is that there is always a better way. And even when you do get to the better way, there is another better way on top of that that is always there. And this is a continuous process, and it never stops. So I can really empathize with what you're saying out there, and it is so, so true. So let's kind of, close with Paul on the prepared remarks kind of a thing, and then we'll take some questions from the panelists. But Paul, can you address how do you think about use of data and technology going forward into the future? And, what does the future state of the mortgage lending business look like? And what should be the vision and what should be the aspiration that we should have when we are, deploying this at a much higher level of competency and adoption?
Yeah, it's a great question, obviously, and I think it was set up really well by Stan and Sanjeev. The reality is if you haven't started using the tools already, some of these capabilities that we can probably do today in a lot of circumstances, depending on how your organization is set up, you're not positioned well to take advantage of. If you're not already doing a digital mortgage for consumers, it's hard to put them through a fully digital experience. If you don't have capabilities to, when documents come in, prior to documents, going back to data, if you're not doing day one certainty type things and doing digital income and asset verification, which you could probably do on, call it 30% of the files that come in, if not more. Asset verification, which you could probably do on 60% of the loans that you see right now today, if not more. Appraisal waivers exist on a higher and higher number of loans because, again, we've accumulated a lot of data on a lot of properties from a national perspective. If you're taking care of those baseline capabilities, and now you're opened up to vision-based technologies that can look at the documents themselves, read those documents. So if you still need a physical document, you can't rely on the data. You can be reading that document, classifying and indexing that document, and even applying rules against that document to say what the information I extracted from the physical piece of paper meets the agency requirements or the investor requirements to clear this condition. So our first step is always utilizing the data. Our second step is where we can't utilize data because either it doesn't exist or the customer isn't comfortable sharing it or an investor doesn't allow it. Even using technology to look at the documents, extracting information from those documents, and then apply rules against it are all things that are building blocks that you could be putting in place now we take it as a serious challenge to try to get to where 60% of our loans can be virtually touchless, where we can automate a lot of the tasks associated with the process, where we perform dual AUS up front, determine which agency or investor gives us the most digital capabilities we can take advantage of, and then even when we get the documentation, using technology to classify, index, extract, and clear conditions for us. So all those things right now, we talk about it as futuristic. Those capabilities exist, but a lot of it's how well you've set up your organization going back over the last 5, 10, 15 years, and not only for external customers, but for your internal users as well. What tools have you given to your processors, your underwriters, your closers? How have you improved that communication? But we're in a really good spot in our industry to start capitalizing on these things. And one thing I'll add, that outside of this purview is prefilling applications is something we could have all been doing 15 years ago. We have a lot of repeat customers in this business. Data starts at home. If you want to start utilizing data today, look at any repeat customer you have as an opportunity to pull that information into a new started digital application, or to take documents from a previous file that haven't expired that you can use in the current file. There's a lot of opportunities there that all of us can start with if you're taking your first step into utilizing data.
That's very helpful, Paul. All right, so let's kind of go to some of the questions from the audience. And I think one question is, are there any specific ways in which each of you are using machine learning or artificial intelligence? And I would even pose the question back, which Sanjeev alluded to, which is blockchain. When will blockchain really be used by the mortgage lending industry? And what are the examples of machine learning and AI in action today? Let me kind of open it up to all three of you, whoever would like to take that.
I'll take a pass at it, because I think it's pretty close to, some of the things we were just talking about. From a AI machine learning perspective, we like I mentioned, we wrote rules against what we see to create conditions and tasks. Those tasks apply to customers, processors, underwriters, closers. Everybody has specific tasks they have to perform. If you break it down into a single document, if we need a W-2, your first step is, can I use data to eliminate the need for the W-2 because I have rep and warrant relief? Your second step is, if you still need the physical document or the customer doesn't want to give you access to the data, is to look at that document, look at the image of it, classify and index it, and we take it as a real responsibility to take a lot of that administrative function away from our processors. Simply putting the document in the right place and notifying them that it's there and it meets the requirement goes a long way in kind of setting up their day and their responsibilities. And then if you take that to underwriting, at first we just set it up that this should be all you need to qualify this loan. Ultimately, it should be, this condition is cleared and you only need to look at these remaining conditions. So underwriting, I think Sanjeev mentioned this earlier, should be more about exception handling in the future and less about looking at every single thing and checking it off, because a lot of those things can be checked off digitally using machine learning and AI.
That's great. Sanjeev, I think you wanted to address that as well. And I'd be really curious to know when Caliber is going to be using blockchain.
Well, a long way. So I hate to admit it, but look, if you recall, I was mentioning blockchain in the context of the servicing and settlement process with the agencies, Fannie and Freddie. So I think to a large extent, Fannie and Freddie did a great job in combining the single security process, but I think they need to bring it more upstream in terms of the use of technology for servicing so that we can reduce not just the cost of manufacturing alone, but also the cost of servicing alone for 30 years, because servicing generally doesn't tend to be that high and return on equity business as the underwriting, the manufacturing process. So I think my view is that view around the use of blockchain for essentially validating the data and making servicing efficient needs to come in participation with the agencies. And I also think that pooling and settlement is something that needs to happen in conjunction with the agencies. I don't think any single lender has the ability to do that as much as we as an industry have the ability to do that. And as Stan mentioned earlier, we as an industry have pulled together in very, very meaningful ways. And so I'm very hopeful that with really futuristic people who know this, like Stan and Paul and folks who are in the industry, I think we can get there in terms of stuff. But no single lender, I can't see how that's going to work. On the use of machine learning and AI, I completely agree with Paul. I think the use of machine learning in the context of making the processor's role more efficient and condition clearing, that is something that we are beginning to test by essentially looking at collecting the data. As Paul mentioned, in 30% of the cases, data is available, and that's pretty good. So you can actually take that and route the files in such a way that it can get, to a large extent, the decisions can be automated, and there's no reason why it can't be automated. Now, we know that the decision-making process in the Fannie DU and in the DU and LP system by Fannie and Freddie is kind of, we don't know what the rules are. It's a black box, but there is no reason why you can't use it as use your reverse engineered set of rules to get to a point where humans today are just shuffling paper, losing a lot of time on this. And I deliberately don't use money, but time, because what happens is the average cycle time costs everybody, because if the cycle time goes up by 5 days, 10 days, 15 days, 20 days, you're essentially forward hedging all of that, and eventually it's coming down to somebody. Either our margins are lower or the customer is not getting a better price. So you should be able to take something and just pre-approve it and move really fast so that you can not just reduce the cost of manufacturing, but the cycle time of manufacturing. And I think that's really, really important. And so, yes, we are using it, but I would say, again, I would challenge us, and I know we know this as an industry, and say, look, we haven't shown the kind of innovation that PayPal, Apple, Square did in the payments business. The question is, why not? There's just a ton of data, and it's such a highly commoditized, such a large industry. The economics and eventually come down to the consumer. Now, we have used, as you know, Rohit, we have used neural net-based systems for a long time on the retention side. So that's mainly in retention, the opportunities are much greater because you know everything about the consumer, right? And so the ability, I'm amazed. In most countries that I've worked in, a refi happens in a day. Today, respectfully to Quicken, when Quicken says, I can refi in a day, it becomes like game-changing. It shouldn't be game-changing. It's nothing game-changing. I mean, respectfully, Quicken's done a great job. But why is it such a big deal that an existing customer has to take 30 days to refinance a mortgage that we should know everything about? Right? So I pose that as a rhetorical issue, and I see Stan smiling, so I'm sure he has interesting things to say about this.
Sure. Stan?
Well, so clearly there's a lot of solutions, and I think one of the problems that we kind of tiptoe around is the fact that these loans are securitized, and they're securitized through government agencies, and the government requires certain rules and certain information to be touched on and be done in a certain way. And the fact that we have to interface with the government, not only on an origination side, but on the servicing side, in a certain manner and in a securitization fashion, creates a level of complexity where there gets to the point where there becomes more exceptions than rules. And the failure of our industry, from my standpoint, and when I think about it, is that there are many people in our industry that want to be everything to everybody, and that becomes very difficult to automate. And I think the more focused you are and the smaller your box, the more efficient you can be. So we've chosen a very complex world to master. We're in the government space, and our space is a very complicated, government-intense, rule-intense business. However, we've managed to do it in a fashion that's highly automated and doesn't have a lot of things that's outside of our space get in the way. So we've automated big portions of our business without trying to automate small portions of our business, which has allowed us to have a tremendous amount of success in small bands. So we can't do everything for everybody really efficiently, but we can do some things for some people super efficiently, much more efficiently than anyone else. And that's been our approach to the business, is to narrow our focus so that we can get really good at something. Now, in my case, I'm not that good at much, but the little bit I'm good at, I'm really good at. So the way that I think about it is to develop real expertise and real good technology about the part that you're focused on, and then to build out from there. And that's been our approach, and we've had a lot of success with that. And we're turning around, retail originated loans about 45,000 units a month, which is not a simple task. And we're doing it with less originators, less underwriters, and less processors than it took us to do probably 10,000 units in 2016. So when we think about where we are today, just compared to where we were 4 years ago, we're probably 3- or 4-fold more effective than we were then. And again, it's seeing where you are now and using the tools at your disposal today to have a real impact on the outcome. And I think that that's the way you can measure how well you're adjusting, is based on the impact you're able to have. This allows us to retain huge percentages of the population of our existing customers by using some of the things that Paul alluded to: pre-populating fields, narrowing decision-making to small number of boxes that have to be checked and looked at, rather than large numbers of boxes that have to be checked and looked at. And your ability to think about and visualize what you want at the end, rather than the pieces along the way. Doing this like a jigsaw puzzle is a very time-consuming event. If you do it more like you know what the picture looks like, and then just getting you there, that really makes it easier. So if you know what the puzzle is going to look like at the end, it's a lot easier than playing with 10,000 pieces and you don't know where they go, and you're trying to fit them together.
You definitely need a photograph to help you, get to that end point. I think that's a very, very good point, Stan. Look, I think we are almost out of time. I want 30 seconds each from each one of you. What's the biggest risk and what's the biggest opportunity from your perspective for the mortgage lending industry? But just 30 seconds. One risk and one opportunity. Paul?
Sorry, I was muted there. For me, it's always remained the same. The biggest risk is just doing things right, being compliant, and that's where any entity can go wrong, and that's where applying some of the things that we're talking about here, if not applied properly, could get you outside of the box where you've done things well for all of your respective careers and all those companies. So to me, it's staying within that box. The opportunity is being able to scale and leverage with fewer people or continuing to be able to grow. We've had a ton of growth. We have a ton of talented people. Let's make their lives easier and double our size and triple our size. The runway in mortgage is massive, you know, and there's so much that we can take advantage of to all grow. There's room for everybody to grow, you know, even for big companies like Caliber and Guaranteed Rate. We have 3-4% market share on a national basis. That means 90.
The use of technology, you know, could be a threat if not kind of capitalized upon correctly, and the use of data. And on the other hand, it could be a huge opportunity. 30 seconds for you, Stan. How do you see this?
Well, the big
only 30
opportunity is
seconds.
I promise. The big opportunity is becoming the low-cost producer. The big fear is not.
Okay, great. Sanjeev?
I think the big risk to the industry is capital structure of the players and therefore liquidity risk. People need to be as strong as balance sheets, as strong as Freedom, Guaranteed, Caliber. We need to strengthen the less capitalized parts of the industry. I think that's the risk. I think the opportunity is, as you started, and I'll finish for you, is data and digital technology, both for low cost but also increased manufacturing, so that we can scale up and scale down in a business that's highly cyclical.
Well, thank you so much for that. I think each one of you provided a unique perspective, and this was so enriching. I really enjoyed it. I hope everybody else also did. It seems like we're also saying that the mortgage lending industry is ready for the adoption of the better use of data, analytics, technology, and becoming a low-cost producer. There are going to be a number of things that require a public-private partnership to be in place, and we need to kind of get the regulators as well as the agencies to kind of adopt this new technology as well. And that's what will make the industry a lot more sustainable, a lot more effective, and reduce that cycle time, which is so very critical. And I think we all remain optimistic about the possibilities in the future and look forward to that. Thank you all for being here, and I hope everybody enjoyed this discussion.
Thank you, Rohit, Stan, and Paul. Thank you.
Nice seeing everybody. Thanks for having us.
Thank you very much.
Yes, Rohit, it was a great discussion. Thank you so very much. Thank you, Stan. Thank you, Sanjeev. Thank you, Paul, Rohit. It was our pleasure hosting you today. Very informative discussion session. Thank you again. All right. Everyone, to our participants, we will move to our post-poll. If we could get everyone to give us a little feedback on your thought on today's presentation. Again, this will help us to provide other webinars that you will find very helpful. We appreciate, again, everyone's participation today. Thank you very much. A recording of today's presentation will be sent out to each of you shortly so that you can review it again at your leisure. Any questions we did not get to answer, we will follow up with our panel and provide that information to you shortly as well. Okay, everyone? Thank you very much. Thank you all again.
Thank you. Take care. Great job with by
Rohit
on the moderation. Bye-bye. Thank you.
Thank you.